Hi everyone, welcome to another session of HLB HAMT Talks. Today, we are discussing about financial statements and audit requirements under corporate tax regulations in UAE. As per provisions of corporate tax regulations, the taxable income of a taxable person shall be determined based on financial statements prepared in accordance with accounting standards accepted in the UAE for corporate tax purpose. Which are those standards? Accounting standards allowed in UAE for corporate tax purpose are the International Financial Reporting Standards, that is IFRS, and International Financial Reporting Standards for small and medium entities, IFRS for SME. What are the major differences between these standards while we are preparing the finance statements? The first one is the capitalization of interest, that is borrowing cost. Under full IFRS, interest directly attributable to the acquisition, construction, or production of a qualifying asset should be capitalized. But under IFRS for SME, all interest must be expensed, and we don't have an option to capitalize such cost. Investment in associates is the another one. Under full IFRS, investment in associates are accounted for using only equity method. But under SME, investment in associates may be accounted by using the cost model, equity method, or at fair value through profit and loss. That is, we have different options there. Next one is research and development cost. Under full IFRS, research cost should be expensed out, but development cost, if they meeting certain criteria, can capitalized. Under SME, we cannot capitalize any research and development cost, and all such costs are required to be expensed out. Other differences are in lease accounting and some treatment in financial instruments. Because impact of IFRS 16 and IFRS 9 were not incorporated in SME standards, and therefore expected credit loss model as per IFRS 9 and accounting of right-of-use assets and lease liabilities, etc. are not applicable in IFRS for SME. Even though there is a choice for accounting standard, we should not use IFRS for SMEs as a default accounting standard. For corporate tax purpose, taxable persons can use IFRS for SME only if they derive a revenue not exceeding 50 million dirhams in a tax period. If the taxable person not satisfy this revenue criteria, mandatorily they should use full IFRS for accounting and presentation of financial statements. Then the next question we are facing regarding this is whether audit is mandatory or not. If your entity is a qualifying free zone for corporate tax purpose, audit is mandatory. Otherwise, for all other taxable persons, audit is mandatory if your turnover in the tax period is 15 million dirhams or more. Less than this turnover, audit is an optional one, but ensure the accuracy and presentation of financial statements in accordance with the accounting standard you opted, we strongly recommend to conduct an external audit for your financial statements before submitting your tax returns. Another scenario is, suppose you are a tax group for corporate tax purpose, which consisting of different entities, and turnover of each entity is less than threshold of 50 million, which we discussed earlier. Maybe one company 10 million and others are 30 and 20. In this scenario, since the taxable person is a group and total turnover of the group is exceeding 50 million turnover, audit is mandated. Another question is whether there any option for cash basis of accounting for small entities. The answer is yes, if your annual turnover is less than 3 million dirhams. I hope this video shared many information about financial statements and audit requirements under corporate tax regulations. And for more such topics, ensure to follow us. If you require any detailed discussion on this topic or have a free consultation, you can reach out to us by clicking the links provided here. Thank you.